I'm a little late personally, but if other people know how to use ScourgeBot, like they could have been in on this over a month ago, and they would be sitting super pretty right now. So I'm not gonna place any price targets on this because like there's really no way to know. It's all gonna depend on how market liquidity shakes out and what the response is from retail because like there's technically speaking no maximum cap on how high it can go when something like this happens. It's very unpredictable. Hello everybody, my name's True Demon and I am the Devil's Stockbroker. In this video, I'm going to keep it really short and sweet, and I'm going to give you the same due diligence that I gave on Twitter earlier today on two separate ticker symbols that we covered earlier this week. Um, and I'm basically going to break down a separate squeeze situation for each of these and also give you an update on one other ticker that I have been following. For the first ticker that we've been paying the closest attention to that seems to be the best setup thus far for an ongoing squeeze is Troika Media Group. This is TRKA. This ticker, if you go back onto the daily chart, we've seen has been in a bearish channel for a long period of time. It's actually been getting sold off pretty much ever since its IPO date. After the initial volatility from the IPO, they've been just chopping their way downward. But after this breakout, things kind of turned around. As it turns out, I looked back at this. I had some notes on this ticker symbol from June, and somebody asked me about it after this big meteoric move where it moved 200% in the span of about 2 weeks. And it was about on the 16th of June that I wrote my notes down that said that it looks like it was getting very near to a top, and it was honestly in a bad situation because of earnings. And I thought that was interesting that it came onto my radar so much, such a long time ago. But now that it hit my target of 30 cents and has since broken through it, it was worth taking a look at a second time after ScourgeBot, the official bot that runs our due diligence analytics platform here at Hell's Trading Floor, had been alerting on it ever since about the 15th of January. The relative volume on this ticker was bringing the bot's attention to this ticker as it was hitting a 52-week low. So this is one of the things that we look for is big relative volume spikes near a 52-week low that brings our attention to the stock, and then we start looking for things like short exempt volume spikes and other things like rising short interest and or shares going on loan, things like that. So the ticker has recently been just laddering up. What I pointed out on this one was this parabolic curve. This is a parabolic curve of support, which I've found this setup appears very frequently. Usually people look for a cup and handle, but I find that by the time the cup and handle has formed, it's usually too late to take the position. So noticing the floors of support start lifting up and they ladder up and they get steeper and steeper and steeper. When this happens, it's kind of a signal that there's an imminent move coming. So there's some details to give about the news on this particular ticker. Um, the biggest thing was that this company was losing money hand over fist. And that was the case about 6 months ago. They were losing a lot of cash. They also had a lot of debt, and their situation wasn't good. One of the things that they needed to do was they needed to restructure their debt and get a healthier loan program because their financer, um, I thought, was a little bit predatory at the time. Well, as it turns out, they are working with Jefferies, which is a well-established and very well-known, lender with a good reputation, and they also are an underwriter for sale of company stock. And they do things like offer private placement of stock for companies in order to get them funded. Um, They handle IPOs and things like that. So it's a good, well-known company. Jefferies has been around for a long time. Well, as it turns out, Troika is working with Jefferies in order to restructure their current debt. And interestingly enough, this news didn't land until about 30 days ago, but the volume spikes in this ticker had been coming long before that. And it's just very strange because the volume spikes all coincide with like very little sales of stock, even though the price was moving down. A lot of people just like had their shares out for sale out in the market, and somebody was picking these up. So I analyzed this volume very closely, and it seems like there was a big institution somewhere that was just picking up everything that everyone was selling at that time. Um, there was some pretty bad news about the possibility of default and also um, issues with their financing, which is Blue Torch Finance. And all of that was putting pressure on their stock. And it seems like it pushed it down below 20 cents. And ever since that point, somebody was picking up a bunch of shares. And now what we're seeing is the stock is cracked through its 100 daily EMA, which is a really significant milestone. It's a big area of resistance for any ticker that's been selling off the way this one has. And you'll notice that it does form a classic cup and handle. This is a distinctly a cup and handle technical pattern. You can see it very clearly. And that's not all. The other big piece of information to pay attention to on Troika is just the amount of short interest. So the short interest was like it barely existed until the news of a debt restructuring and the involvement of Jeffries came into the scene. Um, and even then, it wasn't a lot of short interest. What I found interesting is that if you go much further back and you go and look for things like short exempt volume, you see that short exempts were spiking on this thing absurdly high at all points during this like lowest pricing level. So, a little explanation of this: short exempts are always a market maker or a broker dealer that is filling buy orders without needing to locate shares of stock for themselves. So, broker dealers, if they run out of inventory of stock, and they think that they can get it elsewhere, like by borrowing from another lender or something, or they think that they can go buy it from a somebody in like the wholesaler market or in the dark pool markets. They can they'll go ahead and they'll fill that order, and they get 4 days to deliver those shares before they become FTDs, and then according to their obligations with SEC's Reg Show or Regulation Short, the market maker slash broker dealer must deliver on those FTDs within 2 trading days, or they have to fill those orders out of the market by purchasing the shares outright from somebody else at market price. And that's their deal, their promise with the person that they're filling the order on the behalf of. So these short exempts were very extreme, and you can see after the spikes came, there was a big rise in the price, and then shortly after there would be another short exempt spike, and then the price tanked. So whenever there's a short exempt spike like this, the market maker is essentially gambling that they can get their hands on the shares one way or another, and they are hoping that they can get it at a lower price than what they are filling the order at. So in this case, it looks like they may have been able to do that, but probably didn't. And then the second spike, they did that, and it seems like they were successful. They were able to fill at a lower price and deliver those shares. But what's been happening recently is these short exempts have been just getting higher and higher and higher. The spikes have been getting bigger and bigger, and the price has been rising each time. And this trend has continued. Now, this is one of the things that I look for on Cortex that confirm my suspicions of a market maker facing a liquidity squeeze. What I mean by a liquidity squeeze is that there's buyer demand in a stock, but there's nobody in the market selling those shares. So, what has to happen is the market maker steps in and fills the orders and promises those shares, thinking that they're going to get them. But it turns out there's not enough liquidity in the market. So, the market maker keeps filling the orders because that's their obligation, but they can't get shares at a better price, so they have to keep buying them out of the market at worse and worse prices. So they end up taking huge hits when they do this. And if it goes far enough, they can end up getting really dunked on. How they get around this is they borrow. They borrow shares of stock. And what they do is they don't sell it short. They borrow the shares from somebody else and they pay a lending fee and they hand over the shares that they borrow to the people that they were filling those orders for, as they were making the market. Well, what's happened with Troika is there's almost 100% of its free float is now on loan, which is insane. The utilization is maxed out completely. So there shouldn't even be any shares available, but IBKR's share availability is up at 1.4 million, which is that's by itself pretty freaking ridiculous. This has only been going up, and now the cost to borrow is getting even higher. So one thing about cost to borrow to be aware of is that usually the market maker is getting the best cost to borrow because they're doing it in bulk, so they get the best offers. But that still puts them at the CTB minimum, which is 132%, and that's extremely high. So even though the market maker gets the best cost to borrow fee, they're still paying a fee that annualized would be 130% of the value of the stock that they're shorting. So they're hemorrhaging money right now. They're trying to make money off of like this super tight spread of like fractions of a penny right now off of Troika, and they're getting hammered right now. So, and they're about to run out of shares to borrow. Like this is it. They're maxed out. And here's the best part. Because there's a T+6 cycle on these shares, these short exempts that these market makers have been filling orders with, they have only until Wednesday to fill a day where almost 1 million shares, it was a little over 900,000 shares, were sold short exempt. So starting Wednesday morning, those FTDs are overdue and they must be filled at market price at the very latest. Like it can even, they like to do it 4 days away. So it could start happening as early as Monday, but by Wednesday morning, those have to be delivered one way or another. So if they didn't borrow enough of them to deliver those shares, they're going to have to start buying out of the market. And right now, the price is already back up above 30 cents right now. So like Troika is in a hilariously good position for a liquidity squeeze. It's even doing pretty well after market. And this is what I've been watching for. And just big shout out to the dev team at Hell's Trading Floor. Without ScourgeBot, absolutely never would have been able to find a play like this so early. Scourge was screaming about this back when it was trading at like less than 15 cents. So if I had been paying attention in January when it lit up, then we probably would have got a position way down here at 15 cents and we would already be up 100% on our positions. So, you know, I'm a little late personally, but if other people know how to use ScourgeBot, like they could have been in on this over a month ago and they would be sitting super pretty right now. So I'm not going to place any price targets on this because like there's really no way to know. It's all going to depend on how market liquidity shakes out and what the response is from retail because like there's technically speaking no maximum cap on how high it can go when something like this happens. It's very unpredictable. I'm just like, this is not a price target or anything. I just happen to see that we have the 200 period simple and exponential moving averages sitting right here at around 46.50 cents. So, like, there's going to be some resistance up there for sure. But, like, just saying that that's not necessarily a maximum. And even up to here, there's a lot of resistance up here because this is where we had the big gap down in Troika back in September of 2022. So the market tanked then, and it definitely, took a big hit then. But that is not necessarily a maximum either, and neither am I saying it's going to go over that. There's really no way for me to know. Okay, it's all speculation from here. So the only thing that I'm pointing out is that we are on this big growth trajectory, and the stock keeps finding these new legs of support. And right now, the market maker is really running out of capital, and or not running out of capital, but running out of inventory of stock to purchase and fill orders with. So if things get really serious and buyers keep coming after it, retail keeps buying, market makers are going to have a really hard time covering all of these orders that are coming in. There's not going to be enough in the dark pool for them to cover. So yeah, there's that. The other thing that I wanted to point out was the dilution tracker data on this. So I did some due diligence on Troika, and they're currently fully diluted according to what's in their inventory. Um, so everybody's been speculating that like, oh, now there's going to be dilution for sure because their price is going up. And the fact is that they have no offering ability right now. Um, their S1 shelf offering was pulled. So the S1 that was previously out on Troika, it's not there anymore. So they're actually not legally permitted. They don't have any available shares that are approved or authorized for dilution or issuance. So they can't issue shares. They do have convertible preferred shares, which have been sold to a bunch of banks that are about twice the size of the float right now. Those are convertible starting at 40 and 60 cents. So there's a mixture of them. There's a mixture of warrants, but mostly it's convertible stock that have a conversion price at 40 cents. So at 40 cents, they can convert and break even by selling into the market. But keep in mind, all these banks, the price of the stock at the time of that issuance was March of 2022. And if you go back in time to that point, Troika was trading at it was like over a dollar. Yeah, it was like just above a dollar was when that offering was made and that private placement. If they wanted to destroy the stock, they would have. And maybe this sell-off was part of it, but it was less than 3 million shares, so I strongly doubt it. There wasn't even that many shares traded in the market on on that particular day. Yeah, it was exactly 3 million shares traded in the market that day. I somehow doubt that it was all one big bank that was selling it all, but maybe, we don't know. Anyway, the point is that most of those shares are still being held by those funds and banks. There's a mixture of them. One name that stuck out was Hudson Capital or Hudson Bay. So for those of you that follow BBIG, it's the same guys that were BBIG's big investor that provided them with financing. So that's one of the banks that is, or one of the capital firms that's got a private placement deal with Troika. So that pretty much brings us up to speed with the situation on Troika Media Group. Their stock is it's been doing extremely well, and I'm just I'm kind of I'm really excited to see what's coming next for this one. We're just gonna have to wait to see. All right, the other ticker that I talked about in my latest Twitter post was Carvana. So Carvana is a really interesting situation that I was talking about on that I was talking about regarding two separate catalysts. The big one was a massive gamma ramp. So um, I'll just go ahead and take you through this one, guys. Um, so I have a chart on Carvana. This is a gamma ramp chart, basically. What this is showing is the percentage of the float that of Carvana's floating shares or marketable shares that would be in the money according to the open interest of call options at a given strike price down here. And it's kind of hard to see because it's stretched out. There's a lot of available strikes on Carvana. What you need to know is that most of this move, that is between 5 and 20% of the float, that's all that's just between $5 and $20 for Carvana. So if Carvana went to $20, then all of these shares would be in the money, or all of those calls would be in the money, and those shares would be available to be exercised by whoever purchased them. So this is the idea of a gamma ramp, where a ticker that has a huge amount of open interest on calls in quick succession of strikes, like strike of $5, $6, $7, $8. If you've got a whole bunch of different strikes laddering up, and there's a ton of open interest on those, then what happens is as the price goes higher, Like say it goes up to like the big one is $10. So if Carvana gets back up to $10, then a whole bunch of shares go in the money, right? And at 12.50, there's another group. So if it goes up to 12.50, all these go in the money. And everything below here, all of these call option strikes are in the money. So whoever's holding those is entitled to purchase those shares at the strike price that they, you know, set in their contract. Well, there's so many of them that up till $25, if the price went up to $25, then you would have about 20% of Carvana's float going in money. That means that somebody owes 20%, or a lot of somebody's owe collectively about 20% of Carvana, the company, to the owners of those call options. So whoever's holding those contracts is entitled to receive those shares, a total of about 20% of Carvana's total marketable shares. And that is what is meant by a gamma ramp, because you basically have these different legs of support at these significant price levels that are in quick succession of each other. And what can happen is the price can find support at each one. In fact, as the market maker who provided those orders or provided those call options by writing those contracts, if they don't actually have those shares on hand to deliver, if those calls go in the money, they have to go to the market and buy them. So that's what can actually cause the price to go up. And as it keeps going up, more calls go in the money. The price goes up even further. More calls go in the money. They have to buy more shares, which causes the price go up. And then more calls go in the money, and it just repeats itself until eventually, like, you have this ridiculous meteoric price rise in a particular stock. We saw this thing happen to SPRT back in September of 2021. It was a crazy affair. Um, the stock went from $8 all the way up to $59 in the span of about a month. It was absolutely insane. So Carvana's in a very similar situation, which you can tell by that chart that I just showed. And that's not all. So the other piece of information was that there's 72% short interest and about 95% of Carvana's float on loan. And just to prove my point, here's my Ortex data. And maybe you subscribe to Ortex, maybe you don't, but there it is. There's the estimated short interest data. And if you don't believe that, here's the exchange reported short interest data, which as of January 31st was marked at about 62% short interest of the free float. So if you don't trust the Ortex data, you can at least go by the exchange's numbers, which is still a pretty huge amount of short interest. And this number has continued to rise as the price has been slowly bleeding downward. The utilization of the shares that have been available for borrowing to sell short, it's been maxed out for more than 6 months now, ever since early October. So at this point, I think it's safe to say that, well, for the most part, Carvana short sellers don't have a lot of ammunition to work with, and the price is pretty low, which brings me to my next point, which is the insiders who have uh, basically been absolute animals about their trading strategies. If you'll notice this chart here on Ortex, this is the insider trades and performance chart, where you can actually see where insiders bought and sold. Every single S marker here is a sale, and every B marker is a buy. And you'll notice that there's a ton of orders where a bunch of different insiders, most of these are directors, presidents, executives, and especially the 10% owner, who we'll get to in a minute. His name is Ernesto Garcia II. He's the 10% owner of the company. These absolute savages top tick the living shit out of their company, and it's amazing. They sold collectively at an average of around $280 per share, and the company, like, most of these guys had bought their positions or received positions directly from their bonuses or their sign-on bonuses, or employee incentive programs, as early as 2018. So these dudes all these guys sold at the absolute top of the market, especially the 10% owner. His name is, as I mentioned, Ernesto Garcia. This guy sold more than $1.25 billion worth of shares in a trading range between around $280 to $360. There wasn't at one point he absolutely hit the top price of the market. He did a whole bunch of different trades. Most of them, it was all done by a third party that sold the shares on his behalf slowly over time. But they did sell a chunk at the very top, and most of them, almost all of them, were above $250. The average price of the sale worked out to be around $320. So here's the thing: that sale of stock, all of that sale of stock, it earned Ernesto $1.25 billion, right? Well, if you if you go to the most recent buyer transactions that took place here, it was in July. Most of the purchases of the 10% owner took place in June, July of 2022. So this dude bought a massive sum of shares at the very bottom when it was trading at approximately $20 to $22. I worked out the math, and Ernesto Garcia II bought back more than 10 million shares for $314 million, give or take a million. This guy this guy bought back 2.5 times his original position that he sold in the market for a 93% discount. He sold all of his shares at an average trading price of $320, give or take $5. And he bought 2.5 times that position for $22 per share. He's an absolute animal. This dude timed things so perfectly well, and he is, after taxes, he's probably still got about $600 million just sitting in the bank. He probably paid anywhere from 40 to 50% in taxes for capital gains on this. But since he bought most of those shares and he'd been holding on to them for more than a year, he probably only had to pay about 30% at most. So his capital gains must have been like a small fraction of his total earnings. But just to be on the safe side with my estimates, I'm going to say he got taxed half of it, according to that size of tax bracket and the 50% tax bracket. So the estimate is, out of that 1.25 billion, I'm estimating he had to pay around $700 million in taxes. That leaves him between 6 and 700 million left over. So that's the absolute minimum amount of money that he had after taxes from this massive sale of stock. And it's just amazing to me. But what floors me about this is that, like, this dude's got enough cash in the bank that he could buy half of the company right now at its current trading price of $8.01. The market closed today at $8.01. This dude could buy back half of Carvana right now with the cash he has sitting in the bank, which is hilarious. And most of his directors are doing this anyway. A lot of them are buying the bottom now that the market has bottomed out. And what I've noticed is that Carvana is just getting absolutely hammered with short exempts. That tells me that there's a lack of liquidity in the market, and market makers are buying up, or they're filling those buy orders with shares they don't necessarily have access to, and they're just promising those shares. So there's no way to actually know for certain. You can go through this thread yourself. It's just sitting out here on Twitter. You can go through it in detail. I've pretty much covered everything here, but the point is that Carvana as a company, while it does have a big debt problem, they've got about 1.8 billion in debt, if I remember correctly. Um, or no, that's their market cap. I can't remember. They have a lot of debt, right? This is known, and it's not very good debt. They're holding on to a massive inventory of cars. Their car vending machine buildings are still worth quite a bit of money, and they also bought Odessa, which is a car auction company. So they have a whole bunch of car lots that they can then put their inventory in and then sell it off at auction. They're also providing that space for banks to auction off cars that have been repossessed, which I thought that was a very interesting business move for Carvana. So all of these things together um, give Carvana honestly like it's a tremendous position because they're just really just sitting on all these cars. It's not something that you want to do as a car seller or a car retail vendor, but at the same time, like these guys are just sitting on all this inventory, which has, it has value. It has intrinsic value. It has liquid value. And the best part is that they can prioritize the sale of their cars over the bank's cars that are being repossessed like crazy. And all of their executives made a stupid amount of money selling their shares at the top of the market when it was at an insane price of over $300. So everybody who's been saying that Carvana's done for and that the market is going to eat them alive and that there's no way they can come out from beneath their debt, you're crazy. Because their executives just made literally billions of dollars off of this company's sale of stock. These guys have so much money coming out of their ears that they are just sitting on. And hilariously, the company is now trading in single digits now after they sold at above $300. Do you really think that these dudes are just going to let this cash cow company die after all of that? You have to be insane to think that these guys are just going to walk away from that like, "Whoop, I guess it's over, guys. We're going to declare bankruptcy and just give up now." Like that doesn't really make a whole lot of sense. They're sitting on so much inventory, and hilariously, like the banks that they're working with that are holding on to their debt, they're also working with them in order to take care of their other problem, which is half of the people that they gave loans to purchase a car have now gone into repossession because of all of the wave of car loan defaults. And now they're tied to Carvana and depending on them to sell their cars in the used market so that they can get something out of it and recoup some of the losses. So it's just a hilarious relationship between Carvana and these banks. And honestly, like I don't see what the I don't see the thesis for Carvana just going bankrupt and disappearing forever working out. I guess it's possible, like they could just walk away and let the company go bankrupt and just run away with their money. That's that's entirely within the realm of possibility, but with it having so much inventory and so much value and collectively all these executives having so much cash to their name and such a huge boost to their net worth, like they could just buy back shares in the company. They can authorize new shares. They can put their money into cash liquidity in the company treasury, continue to just pay off the debt and wait for the market to settle, and then turn right around and sell back into a market once things start to come back in a couple of years. And again, you don't really want to be holding on to used car inventory for that long. It's not a good idea. It's not good for it's not good for the equity value of the cars. But like that's a worst case scenario for them. If I were in those executives' positions, like I would be down for that if collectively they know that the car market will come back after the banks get washed out. They themselves would be able to sustain the hit and keep operating the business for that duration of time and just continue to work off of just selling odd cars here and there and keep, thriving off of what's left of the used car market while they let the banks work out the repossession problem. Anyway, as far as the technicals go, Carvana is getting hammered right now, but it is sitting at a pretty stiff area of support right here. This is where the last leg of support was that I took note of, going all the way back down to their Going back down to their daily volume, you can see that there is a heavy line of support right here at $8, and that range goes all the way down to about $6.25. So this range right here is a pretty thick area of support where there's been quite a lot of volume traded in Carvana. If it breaks this, I would be pretty surprised, but if it dips into it, I might be thinking about buying here. Carvana with that big gamma ramp going all the way out till the end of March is pretty attractive to me. And even though their earnings was pretty bad, it's not really all that surprising. It's also not the end of the world because everybody knows the car market's bad, and Carvana already hunkered down and made their decisions to prepare for that move. So they don't really have any illusions about the situation. Yes, they have a lot of debt to deal with, but they also have ways to deal with that debt. So I don't really think that this is the end for Carvana as a company, and the short interest on it is absolutely insane. So, I mean, you can take it for what it is. Nothing that I say is ever right here. So, in total, bought back about 10 million shares, a little more than that actually. And I expect that he's going to continue buying it because there's not a whole lot of float left in Carvana. So he's got plenty of motivation to go ahead and soak that back up. With only 88 shares or 88 million shares in the float for Carvana, it doesn't take a lot to push the market, especially if you have a few $100 million just lying around doing nothing. So that's my take on Carvana and Troika. I am still watching HLGN for everybody who's been asking me about it. And yes, I'm still sitting on the sidelines right now. The relative volume spikes are getting pretty interesting, though. I'm waiting to see the company's stock establish a floor of support. So as long as I see something like the stock just dancing around at a particular level and spiking down, but not really breaking on a particular level of support, that would be my signal to go long. So I'm waiting for something like that to happen. As long as it's in these down channels and continuing to like make lower lows, I'm not interested in trying to catch a falling knife. I'm looking for the support and for that support to be corroborated by big volume, lots of short exempts, and rising interest in the stock. So we're just waiting on signals right now. Our eyes are on this one, but we are not taking these signals as buy signals. It's just our eyes are on it. We're paying close attention. Okay. So keep that in mind and good luck to everybody. Thank you all so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.